here, the president and lead analyst at Capital Markets Advisors, RIIver International. As I like to say, we are in the clarity business. Now, in our Monday Social Shift broadcast, where we talked about some of the current political and social influences, significant changes based on anti-discrimination protests in the U.S. and the like, I said that clarity was not that easy a commodity to come by right at that moment, and that was true. But clarity is a funny thing because, much like market trends that sometimes move very aggressively up or down and then go into trading ranges where they don't seem to be doing much and are a little harder to figure out what's going on, same thing happens with clarity. And wow, have things clarified in the last 24 hours. And that's going to be the theme of the long bomb and the sharp pencil broadcast today. Now, first of all, we go back to our weekly chart updated through last Friday, because I don't update these day by day based on the fact actually annotating them with all those projections is a lot of work that we don't necessarily need on the longer term. Once again, this is what I consider an intermediate term trend view. Many would consider it longer term, coming out of the lows, last lows out of a sideways 2015 and the early 2016. This is down at 1802 or so before the overall sustainable trend started with this significant hiccup based on concerns over the Fed of all things back into December of 2018 that then rebounded so smartly right into January. And we'll be going over some more of these levels and what happened a little later. And of course, the way we achieve clarity is the macro technical view. What are the major economic, central bank, and at this point, wonderful term, exigent circumstances? That'd be things that blindside the market on fronts that it usually doesn't have to deal with. I think we all know what that's about right now. So here we are with the market having been through this whole rally into the highs in February and crashing back down through a lot of support levels, coming back down, there's my cursor, coming back down through the 3,000 area, which opened the door to 2,600, which opened the door to washing out below this major low 2,300 area low from 2016 and back up. And we've been over a lot in our previous broadcasts of what happened along the way. But out of, at least on a trend basis, out of 2 weeks ago, on the push above the 2970 previous channel down break, using the trajectory of the highs out of early 2019 into 2020, we extrapolated this very significant trend support. So we had that trend support, lots of congestion around the August and September highs, the July and September highs back in 2019. And of course, the 41-week average, which was right into, at the time, about 30.07 2 weeks ago. So this is the upswing chart updated through the end of last week that shows the push above 30.30. Early last week, it backed off just barely to 30.20, never even came close to threatening the lower support around 29.70 and exploded initially, even before Friday, pushing up into the 31.35 area. But after that U.S. employment report, it backed off from low 31s, just pushed straight up to the 3,200 area and finished the week at 31.86. Well, of course, this week, the market has completed the push up. We had said right along that the market was likely to get up to 3,200 area, but the key was the congestion from the way up in December of last year into early February pullback, and that was 30 to 30. And that's the fine line. So it dawned on me that these significant swings that we've been highlighting for people, both the swings down that we saw, you know what, let me close that so it doesn't open up again on us. The swings down out of early this year back through support, viciously back through support, the fastest big bear market anyone's ever seen on the worst economy anyone's seen, and then the recovery on the relief efforts. We have regularly been calling for 150, 170, and $200 and $300 moves in the S&P. And now this is not necessarily a radical shift for us, because we, of course, saw 1987. We actually go back to the market bust in the fall of 73. So we've been actively, technically analyzing the market. We've seen the radical moves before. Of course, there was 2007 into 2008, much more gradual trend. And this is not to boast or gloat about being right about these recent swings, even though some clients have been kind enough to thank us for the projections. But the important part there is adapting your perception of what you're looking for to market conditions. And in this case, hypervolatility rules. And it dawned on me, as I was just saying, that these major moves that we're getting and being able to project when the market broke 3230 to 3200, well, it's probably going to go back and test 3000. When it broke that there are some interim levels along the way, but the next big support, if you break the intermediate term channel, then the broadest uptrend channel from that low all the way back in early 2016 is 2600. You know, we're probably going to test 2600. Did I know it was going to all happen in 1 week? No, of course not. But you make the big projection and let the hypervolatility work for you. So what we have now is a market where we said above 3030, and it was a close 2 weeks ago. There just wasn't much between there. Some nominal congestion along the way, but the next significant area wasn't until 3200 to this fine line of 3230. So projecting essentially a $200 extension of a trend dawned on us. It's very similar. It's metaphorically related to American football, and this is like the quarterbacks who can throw the long bomb accurately. The long pass up the field is known as the long bomb, but they also have to connect with a receiver who is in a definitive position on a pass route to be there where the ball is going to arrive and catch it. And that's just like highlighting the fine line, next technical level. I mean, to say you're going to see the market move $200 and then say, yeah, but I have a pretty good idea it's going to have to stop and reassess into this very fine line projection. Well, that's just what we do, but it is something that in its way might be a bit unusual. And along the way, we also look at the shorter term charts. I said in that last broadcast, the best analysis, trend analysis, the technicals, we'll get back to the macro later, happens on a top-down basis. You look at the longer-term picture, know where the big levels are, but then you also need to narrow the lens and focus down. And I still look at hourly charts and 5-minute charts at times when the market's in a critical phase like it was over the last few days to monitor what's happening as I come to further assessments of the trend. So for people who are trading short term, you're not that interested in sitting for a multi-day move, even if it means potentially, you know, hundreds of dollars in the S&P. Hey, there's nothing wrong with that, certainly. There's a lot of qualified advisors and adept traders who are pursuing that path, and hey, it might be what suits them. Maybe they never like holding overnight positions, which has some merit, but in order to be a counselor to institutions who are holding positions for weeks or months, I developed my skills to extend the view over the longer term. So here we are with the daily chart. This is the June contract. We'll be shifting out of that soon because it's going to be expiring at the end of next week. But here we are with the June contract, and we're looking at 2970 from that weekly chart. Well, look at all the work it did. This was 2965 high, near it again here out in the mid-May, and yet couldn't turn back down and ultimately push through it. 3030 on a very minor basis was the last high on the way down of high of the bounce, last daily high before the market proceeded down to 2600 and lower. So all these things, as they say, are fractal in nature. The patterns repeat themselves across different time frames, and this is a good example. Now, as well as having all that congestion on the weekly chart that I like, it was pretty compressed though. Excuse me. I also was looking back at the daily chart and going, yeah, sure, look at this. 3,200 roughly, but keying on the heavier congestion in the 3,230 area. By the way, you go back here, 3,231 happened to also be the June contract close for the year in 2019 as just a philosophical and psychological level. And that's where we got the next projection and knew that despite the violence, the hypervolatility of the rally, this is where it might stop. And Monday, Tuesday, on the extension of the rally after Friday, right into it. Then we look at the activity yesterday in front of the Fed, a minor blip up to 27 high, but then it actually didn't like what the Fed had to say so much. And we'll get back into more of the negatives that fed today's sell-off. Now, this is from 2:30 Eastern time. To prepare this timely for our broadcast, I couldn't wait till 3:15 because I was not going to have the time to properly complete the slideshow. But the market actually at present, give a quick look here, is down to 3,000. So it's actually dropped further and is back not just testing the top of at 30.35 here, but right into the meat of the 30.30 to 29.70 area. And in addition to have some congestion on the weekly chart, you can see how much more prominent 29.65.70 is on the daily chart. And, so what are we seeing here? Well, this failure going back from 32.30, you say, well, it's not going to get through there. As Sherlock Holmes famously said to Dr. Watson in The Sign of the Four, in a chapter interestingly named The Analysis Process. So it's kind of a broader perception. Holmes said something a lot of seasoned traders understand intrinsically, even if they've never seen it: eliminate the impossible. Whatever remains, however improbable, is the truth. Well, here we are with, will the market get through 32.30? It had a lot of important fundamental influences coming up that we'll be back to in a minute. From the early part of this week, if it's not going to get through, where's the next big level again? Could go right back down to the 30.30 to 29.70 range. And again, it's like the long bomb. This is like the pro quarterback who, when he gets going and he's accurate on a given day, can throw the ball a long way and knows where the next fine line area is, where his receiver is going to be. And as a little bit of practical background on that, just for those of you who are not familiar with American football, This is Darryl LaMonica, one of the early progenitors of the American football long bomb. Passing had become a lot more regular in football, but a lot of it was very tactical. LaMonica was traded for by the Oakland Raiders specifically to set up a long passing game. And here is the young Darryl LaMonica in this clip, and he is shown along with one of his star receivers, Fred Biletnikoff. Biletnikoff was known as a man who had so much stickum on his hands, if he reached out and got even a finger on the ball, he could pull in the pass. For those of you who are not familiar with American football, you're about to watch a thing of beauty that is a lot more prevalent now. But in 1967 through 69, when LaMonica was awarded Most Valuable Player in the American Football League for 2 of those 3 years, it was just coming into greater prominence, partially based on what he was doing. So the long bomb with the sharp pencil. And, here is LaMonica falling back to deliver the long bomb. There you are. The cannon is loaded. And here goes the bomb. And right to Biletnikoff at the corner of the end zone. Here is the sharp pencil. Here is the $200 swing in the S&P, right into knowing, as violent as that rally was, here is your 32-30 right here. And just to show you that this was not a fluke, even back in that time, here's LaMonica throwing a pass to another receiver, a bit longer one. This was about a 40-yard pass, all the way out to where the receiver caught it and ended up just bringing it in at the sideline. Again, this is a sharp pencil. This is having things, knowing where the exact next point is, things are going to be important. So from there we go back to this weekly chart and think about, look at all of the larger levels. And again, these are fractal indications technical charts. Just because I'm showing it to you on a weekly and some on a daily doesn't mean the same techniques we've gone over don't work, along with many others, don't work on hourly charts, 15-minute charts. The person who might be looking for $1.70, that's just as credible for the person who knows that's the level of clarity they're comfortable with. You can only engage in the market on a level that is comfortable for you. And the person who's looking for $1.70, there's no real difference except for the duration of the trade, how long they're willing to sustain the risk. Instead of trading intraday with no overnight risk, then there are people who are looking for $170 or more, $200, who are willing to sit for a multi-day swing once they think the psychology is running in their favor. So COVID-19 started at the end of January. We were warning people right away, this asymptomatic contagion period is going to be a killer. Sorry for the metaphor there, but it ended up being literally true. But the market shook it off based on certain assurances from some people and went to a new high. But once it came back down through that early February low at the 32.30 level, then you get the first of the recent long bomb trades into 3,000. Couple of real serious kicks back up on the Fed first emergency 50 basis point rate cut back on March 3rd, and going into the evening of the 3rd into the 4th, Joe Biden, being obviously the Democratic candidate, caused some real enthusiasm. But as I said back at the time, neither one of those can do with solving the problem with the virus. So break down through 3,000, your next long bomb into 2,600, which it collapsed below, and so on concerns over the U.S. government not really stepping in line timely with relief. Once it did, you get your rally back up. Once the secondary package came along, your secondary rally. Market tried to top in here. We'll get back to that temporarily, but ultimately anticipated properly the greater strength to come, and the reopening of the states created a positive psychology. And with the employment report, you pushed up, and this was your next long bomb. The pass out of the 3,000 area that you're going to hit the receiver up at 3,200. Now, what went wrong this week? Because what we know is something went wrong. We know the Fed was very focused on not believing the current employment report was quite as good as you might have expected. But what we saw Wednesday morning prior to the Federal Reserve was the OECD. This was a long time pre-scheduled semi-annual World Economic Outlook. And it said the world economy is on a tightrope. And these people know what they're talking about. I also incorporate in my reports their monthly composite leading indicators. They obviously saw that the outlook's uncertain. They highlighted the GDP changes for this year. And then they went into other quick blurbs, but a collapse in output display. And this is actually an active animation. And I've taken the trouble to put that up here for you so you can see what they were saying out of the trajectory that was expected in late 2019, how dramatically that changed on the initial wave of COVID. I mean, these are massive downgrades to forecast. And they also say we're in a contingency right now. What happens if there is a second wave of infections? In any event, we won't be back to the Q4 2019 levels for at least 2 years, which raises a real question of how did the equities manage to recover as far as they did? Well, one of the other things we know is that the markets are suspect to these kind of indications. Now, I took the link, this very long link up here, and created a short link for use in my research reports for clients so they could access that. If you go a bit further down on there, you can see the press conference by their chief economist, Lawrence Boone. You can see the full written report, many, many, many pages. And I wanted to make sure you were able to see this. And if you pause this video, you can copy it and use it. But all of these things are in my RIIver reports, the newsletters on Ticker Talker. So we're going to head over to take a look at my profile. Hello? Ah, there we are. Okay. Clicked into the broadcast by accident, and you can see where we've got a couple of things here. One of them is the macro perspective, articles, videos, posts, and we're going to talk about the Rosetta Stone in a little while, and the technicals are like the Rosetta Stone, and I actually have a brief video on that, but much other stuff here, including if you want to check out what I was saying in early March, I had a video interview by Phil Flynn of Price Futures Group on the CME floor, and we've got a series of them, and the last one was back in early March. But what we also have here, if we look at my profile, is the newsletters. And these each, the RIIver Alert and the RIIver Research Note, the Research Note has the broader international markets. The alert is just the S&P, but they all are, in fact, including the macro technical analysis. So you can get that by subscribing to my notes, my research newsletters. So here we are back in the presentation, and just very quickly, it's the next long bomb. We are now actually down into the 3,000 area, but with a bounce to 3020. This is going to continue to be interesting late this week and the next. they're much back below that. It looks like the lower congestion is back down below 2,800. And remember our old 2008 view that if the market stalls into the 41-week average, it can head lower. Well, now this market pushed above it temporarily, but then flopped back below it. So if this market had temporarily pushed above it and came back below, it still would have maintained the bear trend. And back below the 3,000 area, the current S&P could also reinstate the bear trend. Much like you can see here. Look at the broader highs and lows. There's a lot of little stuff along the way, but look at how it went right to 2,600 from below 3,000. So we have to keep an eye on this. This is the next long bomb. Do we fail 2,970? We can think about 2,600. And we went over a lot of this previous on the rally up and how it shook off negative signals in here in the 2,800 area and pushed up. And this is because the combined technicals, channels, patterns, averages, breakouts, congestion areas, they are like the Rosetta Stone. This is the stone that was found by the French troops in Egypt with hieroglyphics here and here, but ancient Greek here. And that the Europeans already knew Greek. They were able to do a lot better job of translating what they were seeing on the hieroglyphs after guessing for many years. Well, why guess? You've got the technicals. They're the Rosetta Stone. And once again, this was a big failure. Not surprising where it went under the circumstances of the risk from COVID-19 and the weak economic outlook that comes with it, that after the displacement in the market on last week, that it reverted back to lower ground this week. And we also see we're on this weakness from last week. The T-notes finally came under some pressure. Not so much. They're back up around 139 at present. The German Bund had a very weak front month expiration around 170 in the June contract on Monday. Where is the September contract now? Well, it was up around 173. Now it's back up above 175. All of this reinforces the potential future weakness. And if this fails below 3,000 area again, it's only going to exacerbate the strength in the government bonds. So what have I said about the fiddler? Anyone who's seen a previous broadcast will know this is Marc Chagall, 1924, part of the Fiddler on the Roof series. And the fiddler, again, is a great metaphor for capital markets participants, someone who is applying a very exacting expertise on an unstable footing. Is anyone going to argue with me we apply our craft on an unstable footing after the last week? I don't think so. That's it for now. Hope you enjoyed the presentation. Glad to be here on Ticker Talker TV. And until we meet again, good hunting.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.
Thank you for joining Roar International on Ticker Talker. We hope you found the insight beneficial and look forward to providing you further advantages sometime soon. Bye for now.